Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Day, December 1st, 2009, when the U.S. government, formed its mortgage-creating government-sponsored enterprises such as Ginnie Mae, Fannie Mae, and Freddie Mac, it assured the long-term destruction of the mortgage market, much as the Medicare bill in 1965 assured the long-term destruction of the healthcare market. The coming rush of bank failures is an outcome made inevitable the very day that Congress created the FDIC. Today's guest is Robert Prechter. Robert Prechter has written 14 books on finance, including the Elliott Wave Principle, which has been translated into a dozen languages. He's made presentations on his socioeconomic theory to the London School of Economics, Georgia Tech, and MIT. Prechter won the U.S. Trading Championship in 1984 with a then-record 444% return in 4 months. In 1989, he was named Guru of the Decade by the Financial News Network. Robert Prechter attended Yale University on a full scholarship and received a BA in psychology in 1971. After graduation, Bob played and recorded popular music for 4 years while studying technical analysis. In 1975, he began his financial career by joining Merrill Lynch's market analysis department. In 1976, he began issuing Elliott Wave analysis of the financial markets. Robert Prechter is a member of the 999 Society, that is, individuals who have scored at the 99.9th percentile on specific IQ tests. This compares with Mensa International, which admits applicants who score at or above the 98th percentile, and according to Peter Eliades, a darn good wedding drummer. Robert Prechter, welcome to the program.
Well, thanks for having me on.
Yeah, we're just delighted to have you today. Bob, as our listeners already know, the MTA Podcast Series dares to venture where even Oprah fears to tread. You're headquartered in Gainesville, Georgia. Now, I did hear rumors during the previous administration that Yale grads have a penchant for NASCAR and bass fishing. Not that there's anything wrong with that, but I was surprised by your choice of a home base. Perhaps you were attracted by the change of seasons, drought, rain, drought. Tell us, how did you end up in Gainesville?
Well, all of those things were factors because it lends some excitement to life. But Probably the main reason is that even though I was born in New York State, I, for the most part, grew up in the Atlanta area. And so I persuaded my Connecticut Yankee wife to move south after a number of years in the Northeast. We looked up and down the coast. We didn't like it. We went to Atlanta. It had gotten too big. And just north of Atlanta, about an hour, is a beautiful 40-mile-long lake. And we decided it was a great place to raise a family and a good place to be fairly isolated from all the noise of Wall Street. And we've been here ever since. That was back in 1981.
Mm-hmm. You have a lot of well-known analysts pass through Elliott Wave International. We're going to get to more about EWI in a moment, but does that ever present a problem in recruiting analysts to work with you?
No, because actually most of our analysts live out of house all around the country, even in other countries, because most of their work can be put directly online once they learn the system we have for entry. And they love it because they can work directly from their homes. They can be dressed in their pajamas or whatever they want to do. And it's great for me, too, because they don't spend any time commuting and traveling or dressing, let's face it. So that's good because they've got an extra hour or so to put into their work schedule. The customers love it, so everybody's happy.
As a matter of fact, you're in your pajamas right now.
No, I'm not, but I have heard of people going on TV, you know how they do the headshots, and they'll wear short, they wear their suit jackets, but hiking shorts or something like that. I figured that's not worth the risk.
Okay.
Someday they'll pan back, so you should.
Right. Let's look at this timeline for a moment. In 1975, you walked into a job interview at Merrill Lynch, and you tell them you spent the last 4 years playing drums, and now you feel you're ready to work with Bob Farrell. Tell us about that job interview.
I was so desirous of having that position because I knew that my backup the only choice I could think of as a backup was to become a broker and somehow work my way into a technical analysis department that way. I had already been to 3 other firms on Wall Street interviewing. All of them had technical analysis departments made up of one guy, and they didn't even want to pay for an assistant. So Merrill Lynch seemed to be my last and best opportunity. So I did mention all of the great advantages I had, such as having been a musician. And Bob said, well, what good is that? And I said, well, I'm not afraid to get in front of a crowd, and I can be a speaker for you. And one of the things I mentioned at the time was that I thought was a plus is that I had no experience. And he said, well, what good is that? And I said, well, you can teach me your way. Because I had found out that, hiring from other firms brought some people in that were stuck in their ways and not really conforming to what Bob wanted. Anyway, I did everything I could to... and the third thing I said was, I come cheap. and I did, because I think I started at $15,000 a year, and that was just great for their budget, and it was fine for me, because it got me into the profession that I really wanted to be in. It was a wonderful place to learn. Bob was a great boss, because he basically said, here's what I need. It's going to take you half the day, and the rest of the day I want you to do something useful, whatever excites you. So each person in the department specialized. We had a specialist in options. We had a specialist in interest rates. We had a stock picker, and so on. One guy was a specialist in applying the computer and keeping up indicators through it. And so I said, well, I don't see a wave and cycle guy here. That'll be my job. And it was just a terrific place. Mm-hmm.
That goes exactly to the next part of my notes. But before we go there, I'm going to promise our listeners I'll never bring this next point up again, but I just can't resist asking you about it. What I've found in previous interviews with other technical analysts, Chris Carolyn, Peter Eliades, et cetera, and myself, is that there often seems to be a background in music or the arts with us. What do you have any thoughts on that? Have you ever considered just why that is?
The guy that I replaced at Merrill Lynch was a bass player. I really don't know if there is a good connection, or if so, what it is. But there are diverse elements in the market operating all at once. And when the indicators and the market action, the price patterns, and so on are divergent, there's no quote-unquote music, and when they are convergent, there is. And I think it kind of gives me the same satisfaction when I can see the wave patterns, the momentum indicators, the sentiment indicators, and so on, all converging at the same time. There are times when I'll have opinions when that's not happening, but usually they're not the aha type of opinion that comes to the fore. I've also found, generally speaking, that engineers do not make very good market analysts, because the market is not physics. You can't depend on it to give you the same response or the same action every time. You have to be extremely flexible, the way you are when you're playing music for a crowd, or if you're in a band and you're bouncing ideas off of each other musically. So I think there's immediate flexibility has a lot to do with it as well. And I also think people that perform are willing to take risks. They stick themselves out in front of a crowd of people, whether they're on stage or in some other form. Most people, as you know, would rather suffer slow death than get up and speak in front of someone. Mm-hmm. So I think a performer is doing something very, very few people like to do, and the same kinds of risks occur in the stock market. I think one reason people don't make money in the stock market over a complete cycle is that they're too afraid most of the time, whereas a market analyst or a trader has to be willing to walk in front of a bus and assume it's going to stop. And now sometimes it doesn't, and you get hurt. But the people who are too afraid to do that are always doing the wrong thing, because they're hurting constantly. They're buying when prices are high because they feel safe. They're selling when they're low because it makes them feel safe. And the only way to make money is to do the opposite.
Mm-hmm. Mm-hmm. No conversation with Robert Prechter would be complete without at least touching on Elliott Wave, and I want to take up where we left off a moment ago before our discussion of performance. You often tell the story about how you were unable to find any of Elliott's writings in the Library of Congress, but your library, I guess it was your local library, had them on microfiche. How was it that you were even going to the trouble of trying to find those writings? Your bio says you started using Elliott Wave in 1976, which was only a year after you were hired by Merrill.
Well, actually, I've been using it before I got hired, but I was working from a very sketchy understanding, having picked it up from reading Richard Russell's newsletters. He was applying the Wave Principle in the mid-1970s with A.J. Frost upon occasion, and I was teaching myself all forms of technical analysis at the time, and that was just one of them. But I began keeping an hourly chart and a daily chart by hand, and I could see these waves moving in 5 waves in one direction, 3 in the other, and I thought, this is interesting. And then when I got to Merrill Lynch, a colleague gave me a copy of Hamilton Bolton's 1960 book called Elliott's Wave Principle, and that led me to realize, oh, there's a lot more to this than I'm being told. And then I found out, or I decided to see if I could find Elliott's books, which Bolton mentioned. And the Library of Congress, as you mentioned, did not have them. I went to the New York Public Library and started going through the card catalog, and there it was listed. I found out it was on microfilm and got copies and realized there were things in there that even Bolton did not mention. A lot of that was lost to history. So I decided the world needs to see this material, and I put it all in a book, which today is called R.N. Elliott's Masterworks and includes some of his best theoretical observations from his market letters. And I've also reproduced all of the market letters he ever wrote in another book, everything by Hamilton Bolton, everything by Richard Russell and A.J. Frost. So we have the whole continuum from the 1930s pretty much to the present.
I see. We're going to continue with Robert Prechter in a moment, but first a reminder that on next week's program we'll have as our guest Tom McClellan, the standard bearer for the McClellan Oscillator. Bob, let's talk socioeconomics for a moment. The philosopher Friedrich Nietzsche is quoted as saying, "Madness is the exception in individuals, but the rule in crowds." That sounds an awful lot like your socionomics ideas. But I'm always curious. I mean, I buy into the whole idea of herding, but as far as the individuals part of that statement, are you just being nice to the individuals you're speaking with when you say that, or maybe you haven't met my wife? What causes this disconnect between individuals and crowds?
Well, obviously a crowd is made up of individuals, so the individuals have to have a certain part of their mental makeup that allows them to participate, and that is a corner of their mind which is, from the point of view of rational analysis, mad. But it's really the wrong word, because
which word is the wrong word?
The word mad or madness, when applied to herding, it's mad if your goal is to make money in the financial markets, but that's a relatively modern phenomenon, and the unconscious mind was greatly formed thousands and thousands of years ago as human beings evolved from lower animals and then went from one type of hominid to another and so on. And these parts of the brain were very useful in keeping the species alive, because when someone saw others running in a certain direction, he didn't stop and think. He said, I better join them because they must know something I don't. Well, if you do that in the stock market, you'll find yourself buying high and selling low over and over and over again. So it's very important to understand that you have this impulse, that you desperately do want to join the crowd. It's an unconscious push, and that you need to recognize it and understand that this is what's creating the market's patterns in the first place. If you join in, you'll simply be part of the pattern. The only way to do that is to recognize that the market is patterned, and it's patterned unconsciously in the aggregate. And in order to profit from it, or at least anticipate its next move, you have to take yourself out of that crowd situation and begin observing crowd behavior. You can do it through the wave principle model. You can do it through sentiment indicators, and to some degree through momentum indicators. There are some adjunct things such as what is the focus of news and what's on everyone's mind, and does it reflect optimism or pessimism. But for the most part, that's your job as an analyst, is to figure out whether people are at extremes of one emotion or the other, which would suggest that the market is nearing a turn.
Mm-hmm. Last Wednesday, this is the day before Thanksgiving, Wednesday morning I woke up, turned on Bloomberg TV, and there was the news about the problem with Dubai World. Now on Wednesday, our markets, if I remember right, actually closed up fractionally, and it wasn't until the following day, or that night in Asia perhaps, when global markets started selling off, and then of course once our markets opened up on Friday, we joined in. Now that scenario I just spoke of sounds to me like what you just described as running to join the herd. Is that or is that not an example of what you're speaking of, and if not, why not, and if so, why?
Well, not really, because the premise of socionomics, or let's say what I call the insight of socionomics, is that people trading in the markets are not, for the most part, reacting to news events. News events are things that occur as a result of social mood trends that have occurred weeks or months ago. So what happens is, on a very short-term basis, you can get emotional, which are transient emotional reactions to news. But within minutes or hours, the market is right back where it normally would be, even if there were no news. In other words, ultimately, this unconsciously shared herding is in charge, regardless of news events. Now, as far as this Dubai thing goes, you just pointed out the flaw in the argument that news made the market go down. That news was reported before noon on Wednesday. Our market was open the entire day, and if you followed the S&P futures that night, they were making new highs relative to Wednesday by midnight. So 12 whole hours went by with the market going up, despite the Dubai news. And then Europe opened, or Asia opened, whatever, and then they started selling stocks. So the only reason we had a big gap down on Friday is because our markets were closed on Thursday. Otherwise, we probably would have had a pretty, relatively organized decline or stair-step decline instead of an opening gap.
So we
had a closed day. So, the news had really nothing to do with it. Well, and not only that, let me add one quick thing.
Yeah, go ahead.
If you look at the action throughout November into the early part of this month, you can see that we have had 4, 5, or 6, depending on how you count them, upside and downside gaps through the 1095 area on the S&P futures. So this was just another one. If you were looking back, you wouldn't say, well, every one of these news is running everything. We've just shown news didn't have anything to do with this one. It's just another gap in the series. So what you have is this emotional phenomenon that's occurring that has happened before, and undoubtedly will happen sometime again, where you reach a resistance or support area and the market gaps up and down through it 5 or 6 times. There's always news coming out. But I think it's much more interesting to watch what people do, what they've done in the past, regardless of the news, because the news can never make you any money. It's a lagging indicator.
Mm-hmm, mm-hmm.
I mean, let's face it, the Dubai problem had been developing for a long, long time. We've seen articles about Dubai being in a deep depression for the last 2 or 3 years, and what's happened to that city. Anybody who owned the debt must have been afraid of it.
Mm-hmm. In your work, you often cite sentiment numbers in addition to your Elliott Wave analysis, and at the same time, we hear how this rally has seen the exit of the individual investor. And if the only thing driving the market is high-frequency trading and computers talking back and forth to each other, and sentiment is so bullish, if sentiment is so bullish, why are so many people pulling out of the market, and does sentiment really tell us anything in such a thinly traded market as this?
Sentiment's crucial, and it doesn't just tell you what the public is doing, and there are indicators that will tell you, what the institutions are doing as well. I think the reason you don't see as much individual involvement today is that they married the market in 1999. In 2000, they got completely fully invested, and they've been watching their 401ks go sideways to down ever since. We already have had the result of a change toward negative social mood with the development of a recessionary environment. This means people have, fewer means to be buying and selling stocks. But the optimism that does exist is spread throughout the credit system, and this includes the banks, the federal government, and the Federal Reserve. And what they have been doing in this environment is making more quote-unquote liquidity, which just means debt, available. And some institutions have been taking advantage of that, particularly when they feel they may be shored up by the Treasury. So they are running out and buying stocks because there's nothing else to do with the money. But that ultimately is still a result of an environment of increasing optimism, which we've had ever since March. So I think social mood is at the helm of this rally, and this was at the helm of the decline in 2008. It's going to be at the helm of the next decline as well, and that's when people will realize, nobody's orchestrating these moves like a puppeteer. In fact, a lot of the players are getting caught up in their own emotional states, their own mood states, and they're getting themselves again in a precarious position, just as they did in 2007.
We are out of time. I cannot believe how quickly this went. Robert Prechter, it's been fantastic having you join us today. We really appreciate it. Is there anything else you might like to add before we conclude?
Yes, since this is going out to market technicians, I would say do not get caught up in the idea that external forces are moving prices around. As soon as you start thinking the Fed is controlling the market or the economy is controlling the market and is making investors do this and that, you are out of the technical realm. And the way to stay pure and the way to have the most success is to be 100% technical. Look at what the internal market indicators are telling you, what the crowd is thinking and doing. And when you can see the extremes, according to whatever model you're using, that will be your best guide, and everything else is noise.
Sounds like good advice. That wraps up today's MTA podcast. From Seattle, I'm Ed Carlson. You can follow me at fatechnicaladvisor.blogspot.com or contact me at fatechnicaladvisor@comcast.net. Send us your comments and suggestions. Let's keep our stops tight. Good day.